It's great when somebody who's a policymaker also gives you a research agenda. That's one of the joys of being a convener here at the Peterson Institute, is we can do that. It's also good when a policymaker has extensive real financial market experience. That was true of Neil, and it is certainly true of our next speaker. I'm delighted to introduce Bertrand Baudry, who's a friend and currently a visiting fellow here at the Peterson Institute since February. He's also the managing director for finance and World Bank chief financial officer, has served in that position. His research, he's focusing for us and for the world on developing the billions to trillions agenda, leveraging up in a good way, we hope, private sector finance and public sector MDB finance for infrastructure investment and development. More relevantly, perhaps for today, though, Bertrand had a distinguished career in European banking. Prior to joining the World Bank in 2013, he was Group Financial Officer at Societe Generale, and prior to that, starting in 2007, had been Chief Financial Officer of Crédit Agricole. From 2004 to 2007, he was a Managing Director of Lazard and responsible for the Financial Services Group. Previously had done work for President Jacques Chirac on the G8 summit and as Deputy Personal Representative for Africa. He goes back all the way to having been an ANARC and served in the audit parts of the French National Audit Office, which we all know is secret code for running the country. It is a great opportunity, and I'm grateful to Bertrand for accepting the invitation today, because Neil is speaking with both his public sector experience and private sector hat on. Bertrand can speak in very practical terms of what these kinds of regulations and supervision have meant in the past, what they might mean now for banks, and importantly, from a non-American perspective. So thank you very much, Bertrand.
Well, there is another point I want to make. I don't need for once in my life to make a disclaimer, which makes my speech easier. No, thank you very much, Adam, for having me today and for your hospitality, to you and your colleagues in the room for the hospitality you provided me over the past few months. So I've had the rare privilege to be the Group Chief Financial Officer of what is now called Global CFI. At that time, those were just large banks willing to become even larger. So I'm glad I've been upgraded during the crisis. So I've navigated the crisis for 5 years, taking care of the finance of two very, very large institutions, close to $2 trillion assets on the one hand, $1.5 trillion on the other hand. And I've been obsessed during these 5 years with the risk of failing. That was really my obsession every morning. In particular, I can tell you on the 15th or 16th of September 2008, when you wake up, you just have no clue where you're entering. You have very little communication with the other side of the Atlantic, and you have $2 trillion on your shoulder. That's probably the most stressful experience ever in my entire life, although it's not over yet. So I've moved to the World Bank 3 years ago, which had two impacts on my life. First, and relevant to this conversation, first I moved across the Atlantic, so it gave me a perspective on banking from the other side of the ocean. And second, it brought me to the Financial Stability Board, actually, where I represented the World Bank for 3 years when we kind of discussed the final regulation, in particular the TLAC. And I share, even from a different perspective, most of your concern. Actually, I will conclude with that. So it's a rare privilege, actually, to kind of put all this together today in some opening remarks. I will take a chronological view. My first point was, what was it to be the group CFO of a large bank before the crisis, when the sky was blue and when you thought that you could go to heaven? Then what happened, and where do we stand today? So pre-2007, 2008, the name of the game was growth. Size was absolutely crucial. The domestic consolidation in most European countries, but probably for Germany and Italy, was more or less done. And so we had to move on international expansion. That's what the two banks were doing, but they were not the only one. It was relatively straightforward from all perspectives. It was encouraged by the, I would say, political environment. This was a single market, the constitution of large financing institutions across the continent. So all this was very, very much supported. And it was relatively straightforward, even financially speaking, because when you were a large institution, say in France or the UK or in the Benelux, you had a good rating. So you could buy very easily smaller institutions or weaker institutions with lower rating, and then they benefited from your refinancing cost, and then you share the cost, and that's the way you pay for the acquisition. So you do this in retail banking, consumer credit, etc. And that's the way many banks actually have grown, in particular in Central and Eastern Europe and some other emerging markets. So the name of the game was very straightforward. It worked very well. I did that when I was at Lazard, and I did that when I was at Crédit Agricole, actually. It culminated, interestingly, with the acquisition of ABN AMRO, first half of 2007. I mean, you made a comparison with a Boeing being dismantled in a hurricane. Actually, to let ABN AMRO being acquired by a consortium the first half of 2007 was, for me, exactly similar to dismantling a Boeing in a hurricane. We had no precedent of a large integrated banks doing, retail banking as well as CIB business, etc., being dismantled. The truth is that everybody which touched it, besides Santander, which moved away very fast, is gone now, or kind of quasi-gone. So that's interesting too. That was really, for me, the culmination point of what happened before 2007. And interestingly, when I was recruited as Group Chief Financial Officer of Crédit Agricole, I think the idea was really for me to run an acquisition spree, to continue to grow. And of course, that was July 2007. And when I really took my job in August 2007, something happened 9th of August 2007. And then the name of the game was no longer acquisition, but basically disposals and then deleverage. So things can change extremely fast, even if it has not been that straightforward with some still acquisition or the Fortis acquisition by BNP Paribas, for instance. So as a CFO, it had a lot of implication. In particular, the way you monitor your business. What is your dashboard? What are you looking at? What do the analysts ask you when they meet you for the quarterly calls, etc.? And the only question basically was ROE. If you remember, it was just ROE. Deutsche Bank, for instance, and others would say, oh, we can do 20, 25% ROE. That was really the way you basically pilot your business. Profitability was key, and solvency and liquidity were kind of considered granted. It was a sanity check. You had to make sure you were okay from a ratio perspective, but it was really not part of the real conversation. And I mentioned this privately to Adam, I don't think I had any questions on capital or liquidity by any financial analyst during that period. Never. That was not discussion. The point is, how much money do you make? And it also illustrates the tension that you have between market pressure and regulatory pressure. I mean, that's the point that you mentioned. Sometimes the markets puts pressure, sometimes the regulator. It's very difficult to have the two converge, and it was particular true before the crisis. The second element, so it was very easy, basically, and when you discuss a budget, you just focus on the ROE of each business, and that was it. And that is the hurdle, and now you move forward. On top of that, you had the transition to Basel II. And here again, you had a lot of conversation on that. It cost a lot of money. For Crédit Agricole, the transition to Basel II cost us 1 billion euro of investment, IT investment, research investment, etc. So you wanted to make use of it. And it's true that part of the Basel II was basically relying on internal models. And using internal models was also a way to kind of facilitate your leverage. Let me put it this way. So that was also part of the equation. So since you had spent that much money, you wanted to use it. And there was a tension between the US, which apparently did not move that fast or at all in Basel II, whereas the Europeans say, oh, we spent the money. What are the Americans doing? So there was this level playing field tensions already there. The third point is also, as I say, the tensions with the market. There was this kind of broad perspective, in particular in the case of ABN AMRO, that the market knows. So even, the regulator didn't say anything. In the UK, I was amazed that RBS, or before that Barclays, had technically very little capital, if any, and nobody says anything. They say, oh, the market will know. And it collapsed, as we all know. The truth is that, in fairness, I must say the Bank of France did a relatively good job, and none of the large French banks had any liquidity issues throughout that period, actually, because we had a close monitoring of that instruments. So that was really the name of the game before 2007. And the general perception in June 2007 is that this could continue for a while. There was really a concern. Neither from European analysts nor from American analysts, actually. So then comes a crisis and the tensions between market and regulators. Markets reacting way faster and being very anxious and putting pressure, and the regulators coming, and then everybody pushing each other. So I remember in particular in the spring 2008, it was a moment where people didn't really know where we were heading to. We made the decision to raise capital. It was very interesting because we said, why do you raise capital? You don't need capital. The crisis is over. We are in May 2008. the crisis is over. And I remember with the CEO of Crédit Agricole, I said, no, it's not over, it's just the beginning, and I prefer to raise money too early than too late. And we had to fight against our competitors. Say, why do you do that? You create pressure on us. I mean, you might laugh now, but that was tough. I mean, I remember I was at a roadshow, in particular in Zurich, one of the toughest ones in Zurich, because you don't need to raise money. I say, well, I don't think so. And then people say, oh, you are hiding something. Maybe you have big losses that you're hiding. I say, no, I'm not hiding anything. I'm just thinking that the situation has changed and we need capital. That was really the transition that I felt physically, actually. And it was tough because people suspected that I was hiding something else in my agenda. So it has forced us to rethink the way we consider the monitoring of the business, the way we did our budget. So we had to put in place a system where basically liquidity and capital moved higher in the ladder. It was not just about ROE, it was less about ROE. That's where we say, okay, we target a ROE of 12%. You say, come on, 12%, are you that bad? That was the type of question. So the transition was very painful for everybody. Then, of course, you had the Lehman bankruptcy, which put liquidity at the forefront of any reasoning. We had actually in parallel with the conversation on the various versions of the TARP and the discussion in Europe and the fact that we all converged to use the balance sheet of government to support in case the capital of the banks and also to guarantee the refinancing to make sure the system did not collapse. It went pretty well. And that's really when capital and liquidity became central. And that's when analysts, which hadn't raised any questions so far, became the very specialist of, oh, what is exactly preferred stock or what is, core tier one, etc. It's very funny to see how people have moved into ignoring the whole picture to kind of focusing on every detail of the picture. The very same people. I have names. We can discuss that offline. So the perception has changed completely vis-à-vis the pre-crisis. It was no longer about growth. It was no longer about scale. It was no longer about size. It was really about control your costs, control your capital, control your liquidity. The last exception was probably the emergency acquisition of Fortis by BNP Paribas in the fall 2008. And after that, consolidation was done. It's over. It's no longer, you don't need to be too big or whatever. Stop it and now do your own business. Do your homework. So, and that was basically the price we paid. I like to quote in Daniel Bouton was the CEO of Société Générale, once told me, when you wake up a president at 3 a.m. in the morning, you pay a price. But when you wake up all the presidents several times at 3 a.m., you never finish to pay the price. That's what I've heard today. So I think, unfortunately, he was right. So if you add this political pressure, the fact that the bailout was unacceptable, the market pressure, where people wanted to be reassured that the banks were okay, and the regulatory pressure, that really leads to this basically stronger efforts on too big to fail, which has led to what we discussed, and I come back to that right now. So too big to fail, we created the CFIs. That was interesting, actually. I remember one of my conversations, and I say, well, it's good to be a CFI, actually, for two reasons. Because I do believe, first, that the market will force everybody to behave as a CFI. The market will make everybody converge. So whether you're small or big, the market will expect you to have a strong level of capital. So it doesn't make a big difference. But on top of that, to have a CFI label show, oh, you are really too big to fail, actually. So that's a nice way to say I'm protected in a way. So it was half ironic and half serious. But what is interesting is that the crisis provided a complete reversal of perspective and theme. It was the end of growth, very strict monitoring of capital and liquidity, and then we move into disposal and deleveraging. Culmination in France was in 2012, when you had the pressure every month to explain how much you have reduced your risk-weighted assets, etc. So again, to make a long story short, where do we stand now? I think the peak of the banking crisis seems behind us. It's a result of the whatever it takes, all the measures taken, etc. We have established finally the banking union, and Nicolas in this room can discuss this much more in detail than I can. We have a single supervisory mechanism. We have the TLAC, but I really share your concern. It's complex. So we still have some issues. So from my perspective, the biggest issue is the complexity of managing a bank today. It's just impossible. You have so many things you have to follow, not only on a static perspective to be okay on day one, but on a dynamic perspective. How do you move your businesses? How do you organize things? What do you do? This is extremely, extremely complex. If you add on top of that a layer of compliance, that is very, very, very difficult. And again, prone to accident, I suppose. You have the new products. How do you price them? This is a very fair question. Nobody really knows. And since the beginning, people ignore. Is it debt? Is it equity? Is it a little bit of both? And you cannot, as you rightly say, rely on market mispercepting the risk. I think this is not, so we still don't know. We'll see going down the road. So we have this kind of new dashboard, which we have to share now in, before that it was okay, you shared in French with the Bank of France. Now you share in English in Frankfurt, so it's a different story so it's more difficult. And on top of that, not only it's the CEO or the CFO perspective, you need to explain to all your teams internally what it is about. Oh, why do you need to shut down this business? Why do you need to kind of re-engineer this business, etc.? This is extremely complex for non-specialists. So here again, we are just at the very beginning. And this will force a number of very tough and painful business decisions. I worked quite extensively last year on correspondent banking, which is one of the very side effects of this. This is a business which is not very rewarding, not very profitable, but highly risk, so you just shut it down. And there are many businesses which basically every individual decision doesn't make a big difference, but when 20 large banks on earth make the same decision, then you wake up and say, oh my God, did we miss something? So we cannot ignore the real economy when we do all this, and I think it's important to keep this in mind. The living wills, I mean, I've driven the exercise for Société Générale. It's a nightmare. It's very complex. I mean, you have to explain to yourself, okay, what do I do if I die? But that's it. And you have like all these pages. I have to make sure it's working. So I hope ours was not credible, but it's very complex. It has made the job of running a bank extremely bureaucratic. And to a certain extent, it's a big hidden question. Do we want banks to be utilities or not? That's a big question. And it's not said. So when I hear you, this is a subtitle or a footnote. But I mean, do we have to go that far or not? I don't know. So let me finish with that. It's really the business model of banks, which is not really discussed yet, and which is a big issue. The profitability. I mean, I remember 20-25% before the crisis. I don't think there are any banks which is really sustainably over 10% today. This is a change of the crisis. And so how do you finance the economy with this type of instruments? What do you do? And there is a big imbalance between the US and EU. I mean, as you know, in the EU, banks are much more dominant in the financing of the economy. So it raises a number of questions in terms of sustaining growth in particular. If you add to this the threat of technology, if you add to this the uneven approach with the shadow banking, which you rightly underline, the role of interest rates and the yield curve today, which doesn't provide any gasoline to kind of smooth the transition, to the contrary. So we have to think how we want to finance our economy on both sides of the Atlantic. We have to build a holistic vision. What do we want, actually? Now could have put Band 8 and we've changed the system, but we don't really know which system we want to finance our economy. I think the strategic discussion, both at the macro level and at each bank level, is still ahead of us. And more importantly, as you said, we have not tested this at all. I mean, in some peculiar cases, like in Austria, etc. But what will happen if we really have a Lehman again over a weekend? I have no idea. So are we moving from too big to fail to too complex to succeed? I don't know. But what I'm sure is that it's unlikely that after my great Peterson experience, I will go back to a bank. Thank you.
Bertrand, thank you so much. That was superb. I think people will be going back to the transcript of your remarks and pulling out nuggets to think about for some time, which allows me to make the point that not only is this whole event on the record, and obviously President Kashgari's speech being released after embargo by the Fed, we will have video and transcripts of all the discussions today up on the Peterson website, and I assume linked as well on the Federal Reserve Bank of Minneapolis website. So to continue the discussion, let me make a couple remarks if I could. I'm even hitting my stopwatch to make my living will credible. That I do not have the private sector background of either of my distinguished colleagues, so I'm coming at this as a bit of a policy wonk, but maybe I can provide a little bit of a perspective. I think both Neil and Bertrand sort of started us out with the right question for policy. Are we there yet? You know, have we done enough not to prevent the possibility of there ever being another crisis, but have we done enough to materially reduce that probability on a sustained basis without overshooting? And that, of course, is the power of Bill's framework, is to try to think of things in those terms. And another way of putting it, to invoke some of Bertrand's very minor, or expand his religious imagery, is what would it take for me to be saved? What do I need to profess? What creed do I need to adhere to? And I think the point I would like to make is I want to echo and if possible, reinforce three major doubts that were there yet. One of which was expressed by both Neil and Bertrand, one of which was and a couple others that were only expressed by one of them. The first point is to pick up where Bertrand left off, which is we do have a tendency to talk as though the banking industry is an industry that not only should be profitable, is viable, and will go forward. There is a different way of looking at the crisis, which is that we had a fundamentally unprofitable industry in many ways that was juicing up profits through activities that were ill-considered and through supervisory laxity. And this is a controversial point. My colleague Bill Klein, for example, strongly does not agree with this. But I think it is important to at least consider the fact that, like the savings and loan crisis in the 80s, like the Japanese banking crisis of the 90s, you had almost no exit. You had a little bit of consolidation. And you were essentially getting larger and larger institutions engaging in stranger and stranger activities to maintain their return on equity. And you can always turn around and say, well, you know, the analysts didn't fear this. The returns were high. But I think that that is a mistake. And if you just go back and let's think with common sense, and picking up again on Bertrand, if you were having return on equity of 25%, you know, how could that possibly be sustainable? We saw financial sector growing and growing as a share of the economy, in part because the growth of certain asset prices, including real estate. But even there, that, of course, was also not sustainable. As a central banker, and Neil knows this very well, that's the sort of judgment one occasionally has to make. So there's something wrong. There was something very wrong. And a large number of previous financial crises, even arguably the pre-crisis in the sense of 2007 that Bertrand experienced in France, or what we saw in Spain, were because you had banks reaching for yield in ways that were not sustainable. Does too big to fail really address that? Yes, no, not clear. I think this leads into my second point, and this is not meant to be unfair bait and switch either to my colleagues who spoke or the audience. It is legitimate to ask how much too big to fail is the core issue of financial stability. Obviously, by the effort that we're putting in, the Federal Reserve Bank of Minneapolis is putting in, many others are putting in. We have a book forthcoming this fall by our colleague Morris Goldstein on this topic as well. The stability of banks is crucially important, and there is an argument that at least size, if not capital, is crucial to this. But I think it is worth remembering a couple things when one takes an international perspective. There were a lot of countries in Europe, for example, where the problem was in the small banks, not in the big banks. So we think of the Caixas in Spain. We think of, in Japan, it was mostly the smaller banks. There were, of course, examples in the other direction. There were Commerzbank and Dresdner Bank in Germany. There were RBS and Barclays in the UK. But just a way of saying size may not be a sufficient statistic. Now, in a sense, that becomes moot if, as Bertrand and I think Douglas Elliott raised this as well, if essentially the same capital requirements, except for this little sharp uptick for the G-SIFIs, are imposed by markets and regulators across the spectrum. If everybody's sort of forced up, it's interesting, then maybe this is all moot. We don't need to do it. Or maybe it's even politically wise. One can babble about the large banks and then use that to clean up the rest of the financial system or make more resilient as well. But I think we should at least be a little cautious. I think that there is some information here in the fact that it's not simply a function of size. I mentioned this in part at the first symposium, Fed Minneapolis, and forgive me for repeating it, but particularly when we think about the political channel of too big to fail, that clearly is an important part of the story that we're all worried about, or at least most of us are. but that we have seen, whether with the U.S. savings and loan and other crises, with the Sparkassen in Germany, with various other entities, that small or well-organized groups of small banks can be politically too strong. No disrespect to various guests of ours who are here today. Or alternatively, they can be locally strong, which is more the story in Germany, that a Sparkasse becomes incredibly important to a local region, a local government, and in fact, we're sort of seeing the same thing in China right now. So I think it's important to talk about too big to fail, but it's important also to recognize the underlying reality that size is not a sufficient statistic for stability, and that is not the only source of either political distortion or financial distortion. Again, if it turns out that capital is the key and we largely get everybody on the same capital basis, maybe it's moot, but analytically it's worth thinking about. Third, picking up on something both our colleagues just said, which I think is crucial and I've been saying for a couple years, but presumably with less credibility than either of them, is the complexity issue. I think that this is, to me, the biggest distinction of the too big to fail banks or the very large, complicated financial institutions. It is a trope now of the corporate governance literature, as well as stock markets, at least in the US, that conglomerates don't do very well, that you get better performance if you have a clear line of business and your business can be understood by the shareholders and others. I think at a minimum, and Doug Elliott and I have thought about this in the past, but I think the evidence is pretty clear, any claims of great efficiency gains from universal banking or economies of scale are at best overstated and possibly non-existent. We have not been able to find that after decades of people, both for intellectual reasons and self-interested reasons, trying to find that. We have not seen so-called universal banks in Europe or elsewhere show any greater signs of stability. It is very interesting, for example, Bill's scatter plot earlier this morning from his paper, showing that, well, the extent of seeming risk-taking behavior doesn't seem to be particularly confined to the big banks. I think that's entirely fair. I mean, that's the data, and I trust Bill on the data. But the other way of interpreting that is, of course, that the big banks are not, in some sense, less risky either, because they're able to spread across a variety of activities or the size and scale of their balance sheet. And we know from both supervisory perspective and corporate governance perspective that the largest GSIFIs really are incredibly complex organizations, as Bertrand gave us some very visceral instances. And so I think, if nothing else, there may be an argument for reducing size, at least in the sense of complexity. And when you start talking about Volcker rule type things, of breaking up or separating parts of banks, that I think is an argument that still is out there, remains to be made, irrespective of what you think of the capital cost trade-off. Let me make a final 2 points. The first is picking up again on what is it we should care about besides too big to fail. I think the biggest lesson of the financial crisis analytically has to be that not all lending institutions or investments are the same. In a simple sense, our distinguished colleague Olivier Blanchard just reissued his textbook for intermediate macroeconomics, and the big step forward, he said, of lessons from the crisis is you have two interest rates. It's not everything gets priced off of one Federal Reserve rate at the short end of the yield curve. I think putting it more realistically, what happens most of the time, the only reason that financial institutions should be making any kind of supernormal profits is because they have to do loan assessment or investment assessment of things about which there is imperfect information and there is risk. Otherwise, there's no reason for them to be making profit. But if that is the case, then by definition, assets do not easily substitute for one another, and you cannot simply play games with risk-weighted capital to make up for that. This is also my concern, and I think there are people more sophisticated than I who can defeat this argument, including our friends Amadi and Helwig. But I remain troubled that when I look back at the Swedish financial crisis and the Canadian financial crisis and the Japanese financial crisis of the 90s, all of those institutions were well above the capital standards of the time until the crisis hit. That capital is to some degree endogenous to the sky being blue and the path to heaven being clear, or as I put it differently, it is like a bank run. If anybody has to ask you how much capital you have, then you're in trouble. It's only enough capital if no one ever has to ask you, and in a sense, that's what Bertrand was talking about. And so I do worry that we may be putting too much faith in this, and therefore I completely agree with the statements made by Neil and by Bertrand that TLAC and living wills and resolution are a terrible mistake. That the COCOs and the bail-in securities will not work. They will feed problems. I believe our colleague Simon Johnson has written about this. Avinash Persod, who was with us, has written about this. It's not going to save us. That's my stopwatch, which I don't know how to turn off. So, in conclusion, I think we're not there yet, not for lack of trying by the Federal Reserve, by other supervision regulators, by the FSB, but I do think that there is a huge cost to being too narrowly on capital, even if we are correct to think hard about what's the right level. And one thing which we did not discuss today, which is beyond today's discussion, but I think is important, is when we talk about overregulation, the key has to be for the so-called shadow banks, but also for things like insurance companies and pension funds, how much they're getting caught up in these notions of capital and short-term liquidity that may be appropriate for banks and are completely inappropriate for long-term investors. But that's a symposium for another day. Thank you very much. I'm now going to open it up to questions from the floor.
First of all, thank you, Adam and Bertrand, for being here and for, again, co-hosting this. I welcome your comments. So I'm happy to turn it over to the audience.
Thank you very much. So, again, this is on the record. We turn to you. There's a roving mic in Christopher's hands up front. There's a standing mic for the ease of people at back. Please raise your hand or go to the mic and then be recognized, please. Oh, and please do identify yourself.
Hi there, Kyle Hauptman, Main Street Growth Project. I have a question about the bankruptcy reform, Chapter 14 or something like it. One thing, everybody came out of town, like Neil, you probably flew on an airline that's gone through bankruptcy. Most of them have at least once. And I'm reminded of 2008 when the government let Lehman fail. It was a big downside surprise, and there was that joke, man, who's Lehman's lobbyist? And that shows you everything wrong with a government-run political appointee process. And I'm reminded of 2008 when Lehman failed. It reminded me of in baseball when the two guys let the ball drop between them. The government said, Lehman, you got to figure it out yourself. Lehman thought, worst case, they're going to have what Bear Stearns did, kind of a shotgun wedding. And that's one of the reasons I believe they turned down their last-minute August 2008 equity investor Korean Development Bank. That was their white knight. I think they would have taken that deal if they knew they had a bankruptcy option on the table. Either the Chapter 7 that they went through, which was not what we wanted, but what every other industry has. If they had a restructuring tool, the right people would have been involved here, shareholders, creditors, instead of just government. So can I ask you to discuss the efficacy of a Chapter 14-like process if we'd had it in 2008 and everybody knew that was on the table?
So I'm sympathetic to your view. The concern that I have is, unfortunately, the complexity that we saw of banks is much higher than the complexity of even our biggest manufacturers. And you saw the carnage that the Lehman failure created in financial markets, not just in the US, but around the world. And in the 2008 crisis, it wasn't simply one bank running into trouble while the system was otherwise stable. It was many large banks in trouble at the same time, and people didn't know who was safe and who wasn't. So when we think about things like, I look at the bankruptcy option, whether it's Chapter 14 or something different, it's not that different than resolution and what they're trying to achieve in resolution. It's trying to provide order to chaos. Order can be achieved in chaos, in my mind, if it's one bank, everyone's confident that it's one bank, and there's no panic of it running to all these other institutions. So whether you do it through bankruptcy or you do it through some sophisticated resolution mechanism, I think it has the potential to work. My big concern is that, if you are a bondholder of Bank X and Bank Y just went into bankruptcy or just went into resolution, and the bondholders there got haircut, how do you feel? You think, oh my gosh, I might be next. I'm going to panic. I need to get out of this situation. And so it's that contagion effect that makes banking different than other institutions and makes this so hard to solve. And so, I mean, I'd love to get there, but I haven't seen it yet.
Can I just add something?
Please.
Is it okay? Yeah. No, just to add, as I said, I vividly remember that day, and I remember I did a lot of restructuring at Lazard. In particular, I did the restructuring of Eurotunnel, which was at that time the largest ever restructuring. And so the CEO of Crédit Agricole called me on the 15th of Sunday, after I think it was the 15th of September, to say, Bertrand, what does it mean, Chapter 11 for Lehman? I say, well, I'm not sure I know, because I mean, it's for industrial company, manufacturing company. You had $600 billion of debt at Lehman. I told him, I really have no clue. He said, okay, Bertrand, let's meet at 5 a.m. tomorrow morning, and we go like this until it's over. And what was difficult exactly is it was a systemic thing. Every morning, we had to make a decision. And that's really this kind of too big to fail real environment. You had rumors spreading on Citi, let's say, on Monday or Tuesday. So you had the decision-making body at Crédit Agricole, like in any other banks. Okay, do we continue to trade with Citi? And the answer is, well, probably not. And then you say, well, but you know, you cannot really be killing them. But you don't want to be the last to kind of remove the ladder. So it's awful. I mean, it's really game theory. And then you say, okay, let's say do not deal. And you have no intermediary position. So you send the order do not deal. So all traders all over the world stop trading with Citi or with whatever name. I don't want to target Citi particularly. And then immediately, 15 minutes later, you have a call from the CEO of Citi. Bertrand, it must be a misunderstanding. I understand your trader don't deal with us anymore. What's happening? And that has been exactly what happened. And you don't know how to handle this until it's solved next weekend by, no, it was just a rumor, everything is okay. Or whether the government took over, like with Dexia and others. So that was really a very, very difficult thing. And that's exactly the point. It's not complex. It's a very straightforward decision. You do or you don't. And how do you make it happen?
Thank you. That's very helpful. At the rear mic, please.
Yes. Can you hear me?
Yep.
Stuart Rosenblatt, work with EIR News. I liked Adam's remarks. I liked all the remarks, but I thought Adam's remarks were good in just simply going through how none of these proposals really are going to cut the mustard, TLAC, bail-in, and all sorts of things. I just want to reiterate this question. For 66 years, Glass-Steagall worked. It worked. And it was the repeal of Glass-Steagall in 1999 that led to the creation of the universal bank model or led to its expansion into the United States that you said, frankly, doesn't get you anywhere and created this massive pile of bad paper, concentrated in housing, but really reticulated through the entire system. We're there again. Nothing has been resolved, from 2008, 9, 10, call it what you will. Simply the location of where the bad paper has changed. Now it's in the stock market. Wall Street Journal did an article a couple of weeks ago. 1,500 biggest companies in the United States are simply borrowing money to buy their own stock. That's all they're doing. That's at least a big part of the new bubble. That's going to go. There are 2 bills in the Congress right now. There is a debate in the Democratic presidential campaign to restore Glass-Steagall. My question again is, break these banks up by structurally and that does get at the complexity problem also. Very elegant, has a track record of 66 years.
Neil, Bertrand, and then I'll put in one optimistic change.
Sure. So I'm not opposed to reinstituting Glass-Steagall. I agree with some of the benefits that you said. It will simplify the institution. It will have an effect on size. And I also don't want to design regulations just about the last crisis. It's like defeating the next terrorist. We tend to focus on the most recent one. But it doesn't mean we can ignore the most recent crisis. And so if I look at the root cause of the 2008 crisis, it was about bad lending. It was all of us participating in the nationwide delusion that home prices only go up. Banks, commercial banks and investment banks made bad loans. Borrowers took out loans they shouldn't have taken out. And to me, when I think about the 2008 crisis narrowly, it isn't obvious to me that if Glass-Steagall had been in place at the time, it would have changed much. And so I'm not opposed to it. I don't think it's a bad step, but I don't think by itself is a complete solution to the too big to fail problem.
Bertrand, do you want to?
Yes, first of all, as a reminder, we didn't have any Glass-Steagall in Europe. And it worked as well for 60 whatever years. So I think it's a very interesting conversation. We had this conversation when we had this discussion led by Erkki Liikanen at the European level, or the Vickers conversation in the UK, which were more or less about the separation of retail and CIB business. I'm still unclear on that. To be honest, I'm not totally irresistibly attracted into separating things. Because when you look back, and maybe when you look forward, you have cases where business models were very simple. I mean, what was the name? Northern Rock or Dexia. It was very simple. Glass-Steagall wouldn't have changed anything. And you have very complex institutions which have navigated well. So one of the issues which we looked at when we were questioned by the Liikanen people, you say, okay, if we separate retail bank and CIB, then the retail bank will get the highest rating and will continue okay. But the CIB will lose its rating. So basically, it will lose its market capacity. And then it's going to be even better for the Americans, to be very straightforward. I mean, one of the very interesting outcomes of this crisis, and I will take my European hat, is that the investment banking business from the US is more dominant today than it was before the crisis that they started. So if we want to maintain some European capacity in these very important and strategic activities, this is also part of the reasoning. That's, to my point, we have to take a holistic approach. How do we want to finance the American economy? How do we want to finance the European economy? What type of players within the banking system, within the shadow banking system, and within the whole system? And we haven't I don't think we spend enough time to think about this big perspective. And for me, more than the Glass-Steagall, etc., it's really about the quality of supervision, the quality of governance. Again, if people do their job, you can make a real difference. I mean, the real issue is that Northern Rock or RBS were not regulated. Neither was really Dexia. Dexia, actually, you had a tripartite agreement between Belgium, Luxembourg, and France. And of course, when it collapsed, it was no longer French, but Belgium by definition. But it didn't really work. So that was the complexity. You craft a very nice agreement where everything is scanned in the paper. But when you have the crisis, you have to decide in two days. You don't read the 150 pages of the MOU. You go straight to the solution. So that's typically the type of solution we need to address, being simple in the supervision and credible in the supervision, and make sure the board and the regulatory, and the governance bodies know what they're talking about.
Just, again, thank you for your encouraging us in this direction. Let me just give a slightly different perspective. It's actually a little more optimistic. I take a lot of what these guys said. Some work I've done that's supported by the Sloan Foundation, disclaimer, it's not the Sloan Foundation, it's just me. But I'm grateful for the support. Indicates that where and what kind of bubble it is and where it is in the system matters a lot. The real estate bubbles are really much worse than equity bubbles, for example. I mean, this has actually been true for a long time. And there's a bunch of reasons, political economy as well as structural, about why that's true. And so, while again, I'm similar to Neil, even more so, I think that there is a real argument for separating out retail. And that gets us into the question Bertrand raised of how much of a utility you want to treat the banking as. But I do want to say that one place where I think the Fed and the FSB and the European supervisors have done something right, perhaps inadvertently, because they seem to not like it now, is driving a lot of activity out of the formal banking system into what they call shadow banking. I don't view that necessarily as bad, because if they're not part of the official safety net, I'm less worried about the bailout risks. And sometimes they'll fail and it won't hurt that much. I mean, there is a record of hedge funds failing without blowing things up. Again, I like my colleagues. I want to be a bit humble here. I don't know what the answer is, but I do think maybe Glass-Steagall isn't the right way to divide it, but I think you're right that we have to think in terms of structural breaks. The lady right there, please.
My name is Barbara Opper, and I was a Federal Reserve Board economist and financial policy at the World Bank. A couple of things. One is, no one has used the word payment system, and that's a really important dividing point in thinking about the impact of failures of firms on the economy and on the distribution of that risk within the economy. So I think we can't be simple-minded about thinking about one failure versus another without that. Another point, if I can, in the United States, we had 3 financial crises in the 20th century, 1907, 1929, and this one. If you look at the 3 official reports about the causes and distributional effects of those crises, it is all the same. And one of the things that recurs is the combination of investment banking with the deposit-taking function of the commercial banking system. Again, it's because of the impact on the payment system, and it's because of the maldistribution of risk. Because when the two are combined, the investment banking function, when it is profitable, earns great rewards for those participants. And when it is not profitable, it's, as Louis Brandeis said, they use other people's money to cover the losses. And so whether it's called Glass-Steagall or not, I think it's important to understand that those two functions really are not compatible within the same corporate structure because of, we have 3 now crises in the United States. All 3 of the official reports point, among many things, point to that combination.
I'll buy a little time for Neil and Bertrand if they want to reply. I think on the payment system, though, I just want to say that is a general and generic problem of these discussions, that as you well know from your Federal Reserve experience as well as elsewhere, that bank supervision, regulation, and monetary policy get separated, and payment system is separated and down 3 floors, treated as plumbing. And there are some serious people, and I'm sure my colleague Ted Truman will tell me on various Basel committees he served about payment system, and it does matter a lot, but it doesn't quite get integrated in. My concern on the payment system front relates to something Bertrand and others were raising, which is if there is a lot of financial innovation on payment systems, as we're now seeing, even more than was the case before the crisis, there's pressures on essentially disintermediating banks or a lot of competition for banks in that way. That is potentially very good for financial inclusion and efficiency. It is potentially extremely disruptive in the short term. Our colleague Simon Johnson, with his MIT hat on, is doing some work on this. A visiting fellow, Martin Charzempa, is doing some work on this. This is a very serious issue, and ideally people will look at the financial stability aspects of these innovations as well as the efficiency, but I don't know if you all.
I mean, the only thing I'll just say, going back to the 2008 crisis, again, I'm not opposed to, I don't have a religious opposition to bringing Glass-Steagall back, but just think about securitization as one example. So securitization, I think most people would agree, was taken to an excess leading up to the crisis. Mortgage-backed securities becoming CDO squared as an example. And so how does that work, just conceptually? Picture you're a big universal bank. You've got your lenders, you're originating the loans on one side of the bank. Then they pass those over to the securitization guys on the investment banking side. They package it up, and then they sell it off to unknowing investors around the world. Those banks got into big trouble in part because they got stuck holding some of that before they were able to push it out the door. So imagine how you separate it. I'm not sure that much changes because those securitization arms of the banks weren't just taking their own loans from their own originators. They were also taking it from other banks that were originating loans, the pure play lenders, the pure play commercial banks, or the pure play retail banks, and also packaging it up and selling it out. And so putting that big dividing line, at least in that one case, I'm not sure that it changes very much. Maybe they were more willing to package their own originated loans than they were to loans they got from someone else, but that isn't clear to me.
We have time for one more question. This audience surely cannot be satiated. Yes, Chris, sorry, if we can get the mic over here, please. Sorry.
Dennis Kelleher, Better Markets, and being at PIIE, I'll ask an international aspect of this question, which Bertrand brought up, and we run into all the time, and I think was in some ways a major accelerant of the race to the regulatory bottom globally. And that was the observation of, look where we are now. The American banks have eaten our lunch. The American investment banks, not that they technically exist anymore, they're bank holding companies, riding high, big fees, doing all the global business. And what are we left with in Europe? And I was actually just over in Europe, and both in the city and on the continent, and you hear that all the time.
It's still together, right?
They'll stay together. But this kind of national champions of viewing banking institutions, I mean, the governments and the regulators have to be national champions for them. And then the industry being experts at playing policymakers, elected officials, and regulators off against each other across the Atlantic, also now with Asia and elsewhere, it was really an insidious effect that really did accelerate a race to the regulatory bottom globally pre-crisis. And those same words were in the same actions and the same thinking we're seeing happening over again, and here, where all the banks are saying, oh my gosh, the Europeans are going to come eat our lunch, and you can't do that, it's going to hurt us competitively. You go over there and they're saying, oh, those big bad Americans are going to eat us lunch, we've got to lower the regulations, and capital's killing us here, and liquidity's killing us there. And then over in Asia, they're saying, and I don't want to malign a whole area, but there's plenty of places saying, come on over, the water's great, we're going to go down here. And so how is it that when you think through these issues of too big to fail because you live globally and die locally, how is it that you really, and I agree, it's shorthand for too big, too leveraged, too complex, too interconnected. It's not a size issue alone and nobody thinks it is. It's a shorthand. How is it that you deal with it, you're trying to deal with it locally, recognizing they live globally and then die locally?
Thank you very much, Dennis, and you're right. Not only because it's PIE, but because it's important. The international regulatory arbitrage is a huge issue. Let me suggest that Bertrand reply first. I'll say something, and then our distinguished guest gets the last word. So, Bertrand.
Yeah, just another very precise memory, and I come back to your point. I met, so Crédit Agricole was a large counterparty to most American banks. We were one of the largest by size in Europe, so we had a lot of connections. So usually when the big guys from Wall Street came to Europe, they pay a visit to me because I was a good client. So it was very interesting to have this conversation. And one of them, one of the largest bank holding company as of today, told me, Bertrand, there is a difference. The US are bigger than France, and France is bigger than Switzerland, and Switzerland is bigger than Ireland, and Ireland is bigger than Luxembourg or whatever. So it's normal that we are bigger, and you should shut up. I mean, that was kind of, it's probably exactly like this, actually. I'm not sure I'm even making it up. So that's part of this reasoning. So we are the big guys, and you're smaller and smaller and smaller. And so if the Irish are paying a high price, it's because they really play over their grade. And that's, and then I say, well, what about the Chinese? And he didn't laugh, but it's... No, but the point is exactly for me the critical issue, because this is something which is very local. Because for like in many industry, I don't know whether it's national champions, but it's an industry which has a very specific attraction to because it's a different industry. I mean, it's important to the economy, etc., and it's very global, and you cannot ignore both. And that's a tension even within the single supervisory mechanism and the banking union. People are struggling to say, okay, we should harmonize the whole thing, and then say, but bank issuance in France is different than the Sparkasse in Germany, etc. I don't know. I mean, I perfectly know that we need to move to something where there is more level playing field, that we avoid the regulatory arbitrage, etc. I think we've made some progress. Actually, the fact that these discussions are happening at the global level, that we use the same terms, even if we don't have the same accounting system, even there are still discussions on the risk-weighted assets measurement, etc. We are making progress. We are not there yet, and that's for me one of the sources of fragility going forward. So we should not let the effort go, but we should be aware that this effort needs to be continuous and will take years. There is no magic there. There is no magic because the local or regional vested interests are extremely important and largely legitimate, actually. So I don't have a silver bullet, but I think it's a critical area, and that's when I say we have to sink the system, I really mean it. For the time being, we have repaired the system, kind of repaired the system, not totally as we have discussed, but we haven't sold the system.
Just a couple points. On this, I am more concerned and less sympathetic in some sense than Bertrand. I view the sort of national champions fixation, which we've heard, let's be very clear, from U.S. supervisors and advocates as well. It's not just a European thing. It's not even just a French thing. That was a joke. That this is at least as destructive in the financial sector as it would be in any other industry. If anything, the specialness of finance makes it worse rather than better because of what you said, that you die at home. And our colleague Nicolas Ferron, again, deserves credit because he's been on top of this in terms of how national badly defined, in my opinion, self-interest is like preventing cleanup in Italy that would require cross-border consolidation and things like that. There is, to some degree, a limit on this, in which we've already seen, in that whether it was India or the UK, if you're a bank supervisor, at some point you say, I don't care what your so-called holding company is or your structure, you have enough capital for my market in my market. I mean, that was what we in the UK at Bank of England did to Santander. That's what the Indians did in the crisis to other banks. I mean, that's the way it goes. In the end, you say, you're not going to get to pull money out of my country back home to your headquarter country if you want to stay here. So there may be some actual, for maybe not the most idealistic reasons, but some limit on this. The final thing I would say is I do worry a lot about race to the bottom still. And as I mentioned the other day, this to me is one of the underplayed risks of Brexit. I think if the British, as much as we may not love EU bank supervision or bank regulation, I think if the British are out and they have a recession and they're desperate and they're nationalists and they're anti-regulation, the quickest fix is going to be, okay, what do we need to take to have you not lose any more employment in the city? What do we need to give you to become the trading center? And that's going to be even worse if, as Nicola and I and many others have pointed out, a large amount of straight-up investment banking business does move to the continent as a result of Brexit because it's about local deals in Europe. And we saw what happened with AIG Financial Products in London. So I do worry about that quite a bit. Neil.
It's a very real concern. You know, when I first went to Treasury in 2006, I mentioned that we were out there looking for where the next crisis would come from. You know the other thing we were doing? We were working on capital markets competitiveness, because all the rage in 2006 was that the U.S. capital markets were overregulated and were losing out to Europe and losing out to Asia. That's what the world, that was the conventional wisdom. Really smart policy people were writing a lot of papers on how overregulated the U.S. capital markets were in 2006. So we have to focus on what we can control. And my view is if we can actually address too big to fail in the United States and demonstrate that we can do it simply, credibly, and we can still have a robust economy, maybe we can then show the rest of the world, hey, there's a path for you as well. And, you know, it's a very real, I joke, but in his annual shareholder letter, my mic not working anymore? In his, thanks. In his annual shareholder letter this year, the CEO of JP Morgan, Jamie Dimon, at the very end of his letter, was pushing back against some of the too big to fail commentary that's taking place nowadays. And he utilized the ultimate scare tactic. He said the Chinese are going to take over, right? He said that it's not just that the U.S. banks are going to lose out to Europe, we're going to lose out to Chinese banks, heaven forbid. And so we can't allow these type of scare tactics to immobilize us. We can't let the perfect be the enemy of the good. If we can come up with a plan that is credible and that will work for the U.S., maintain a robust economy, strong economic growth, innovation, without exposing our citizens to huge downside risks. I mean, in the earlier panel, your question was spot on. I mean, the costs to society of major financial crises are extraordinary, far beyond what shows up in the data. You know, I think we can show the world that there is a better path forward. So.
Fantastic. That's a great note to end on. Thank you very much.